Welcome to Equities. I'm going to share my screen. All right. As we have discussed before, equities remain by far the most studied and also the most influential all in terms of investments, in terms of financial markets. It's also taken to be a significant indicator of world financial markets, A, and B, also of world's economy as a whole as well. So the famous Wall Street as well as Main Street. So we have discussed equities in quite a bit of detail so far. Now we are going to get into by far the most influential model in finance, which is the capital asset pricing model. There has been a lot of theory on it, and you should read my paper in the Palgrave Encyclopedia on it. There is also some coverage in your textbook and also in Bodie, Kane, and Marcus. So there is as much detail as you want on it. We are going to actually look at CAPM from a perspective of what it actually means, what it actually implies for a financial economist, and we will also, in the process of doing so, point out the limitations of this model and how we can overcome it. All right, so in order to set up the theory, first of all, we are going to make the following assumptions. Investors are rational and risk averse. Investors hold diversified investments. Investors are price takers. Now, this is something you will remember from microeconomics, where this is the perfectly competitive model assumptions that individual investors take prices as given. So they are investors like me. They're not investors like Warren Buffett, who, when Warren Buffett decides to buy 100,000 shares of Coca-Cola, that will profoundly have an impact on the prices of Coca-Cola and potentially substitutes as well, right? So those are, we are restricting our attention for now on investors being price takers. Now, as I said, that is just for now. We're just building up the model, and we'll see how we can then expand that model in various different ways in order to provide more realistic insight in various real life scenarios. And that's why we work with actual data to make sure we understand all of this. Okay. The next one is investors can borrow and lend at the risk-free rate. This is a very strong assumption, because it is just not true that I can borrow at the same rate as I can lend money, or as I can borrow money as Coca-Cola can, or Coca-Cola can borrow money at the rate that the US federal government can, and so on. There's so many gradations in between, and right after the midterm, we will talk about fixed income securities, where we will go through default premiums in a reasonable amount of detail. All right, so this is a strong assumption. Good thing is that these assumptions can actually be relaxed relatively easily. So this is not a matter of a huge concern as far as application of the CAPM is concerned. Rational expectations hold. That is, goes back, it actually follows from investors being rational and risk averse. So expectations are also rational. So this is where the two differences, remember, we talked about. There is variations can come from individual valuations and also individual information. So private valuation, private information, and a combination of the two. In this particular case, to set up the CAPM, we are taking both of those aspects out of the picture. So the second part of that bullet point, homogeneous expectations hold. That is, investors also have the same information. So there is no private valuation, there is no private information either. all right, to set up this CAPM. No transaction costs and no tax implications. That fails to hold, for instance, in the US, where equity returns are treated in a different way than fixed income returns for tax purposes. Okay, that's always the case. Transaction costs also, for instance, with real estate, transaction costs are very, very high. Transaction costs include, for instance, search costs. Okay, so or commissions that go with that are ways of reducing the search costs and so on. So these transaction costs are can be quite significant depending on which particular market you're looking at. So we are abstracting away from it because the idea is we don't want to have that be the focus. We can relax that and develop these models if, for instance, we are talking about real estate where transaction costs are in fact very very important, very substantial. So then we can relax our model for those particular specific assumptions, specific industry scenario, market structure scenarios. We are going to abstract away from it for the time being. And finally, securities are perfectly divisible. And we have discussed this particular issue a lot in the context of stocks splitting and so on, and how to keep track of all that. And as I mentioned before, this used to be a big assumption, even 20 years ago, it was a kind of a binding assumption. But in today's world, where you can indeed invest in 1/1,000,000th of an apartment in Brooklyn, if you decide to do so, because of all these kinds of market aggregators and disaggregators that exist out there because of the enormous developments in financial markets. So securities being perfectly divisible is required for the computations and the of the CAPM to go through, but it's not as stringent as an assumption as it would have been even 2 decades ago. All right, so I use CAPM a lot in my research and consulting, but always with the caveats that it is not perfect. As we have discussed before, we are not gods. We don't know the truth. We are, at best, scientists. There is no perfect truth. There is no perfect experiment. There is no perfect theory. I'm sorry. I think I said there's no perfect truth. My bad. What I was that is not up to me to decide whether there is any perfect truth or not. But what I do know is there is no perfect theory. There is no perfect experiment. All we can do is try to get better and better, and that is the essence of science. Is we have conclusions that depend upon evidence, and therefore these conclusions change with additional evidence. All right, so that's what we are going to really keep that in mind. There are restrictions. How can we improve upon them? What are the implications of some assumptions not holding? And what we shall always do is to test for robustness. How different would our predictions be if these assumptions were different? Those are the kinds of, as any scientific method has to be, you have to test for these robustness implications. Okay, what are the kind of limitations? Having said upfront, variance is assumed to be an adequate measure of risk. And this is bound in with the normality of returns that we have talked about. And we are not going to get too much into moving away from it. In the first 2 weeks, I have discussed in quite a bit of detail. There are various other ways of measuring attitude to risk. Those tend to be much more computationally demanding. So for the purposes of this course, we will restrict ourselves to quadratic utility, and in which case variance is, and of course standard deviation, volatility is sufficient for our purposes as far as measuring risk is concerned. Rational and homogeneous expectations can be unrealistic. Yes, and there has been a lot of work done, especially with the behavioral finance and economics people, including my fellow Rochesterian, Dick Thaler's Nobel Prize, in when was it? Not last year, the year before. And so, there that has been questioned. There is a lot of evidence that it does not always hold. But on the other hand, what are the alternatives? Hirsch Sheffrin, for those of you who are interested, he has developed quite a cottage industry of behavioral based CAPM. So I would be very happy to refer you to some of his work. He's also an incredibly smart man, a very good person. So he has talked about the implications for CAPM when rational and homogeneous expectations don't hold. Right, homogeneous expectation is actually a bit of a different beast, and rational expectations is a bit of a different about whether Bayesian updating holds or not. They're different approaches, different restrictions, but they fall under the same bucket for our purposes now. We have now the third bullet point is that the question is, how consistent do we find CAPM with empirical work, with actual data? And we find that at its simplest model, at its simplest version, it is not quite consistent with the size and value effects that the former French three-factor model talks about. We really won't get into this kind of detail in this course. For those of you who are interested, I actually do study the former French multi-factor models in my papers. Please feel free to look at them. It's actually covered in your textbook as well. So once again, if you want to get into more detail, please do so. There is a lot of work on this, but for this course and for today in particular, I won't get into these former French multi-factor models. And finally, this market index is taken to be a proxy for the market portfolio. Now, in a course in which there is a large proportion of international students, this is not a very hard sell. Saying, S&P 500 is, first of all, only an index for the American equity market. It's not even worldwide equities market. So why would it be so of course it's incomplete. Why would you even suggest that it is complete? I'm not suggesting it's complete, but we are using that as a proxy for the market portfolio. All right. So in order to get even worldwide equity markets, you would need to talk about global indices and so on. Then, for instance, the S&P 500 is the top 500 firms. Why is that necessarily the right submarket to focus on? If you take the value-weighted return, well, that weights the biggest firms much more heavily. Why is that necessarily a good thing? All right. How about real estate? How is real estate investment, which for a lot of people is a large part of their investments, that is not covered in the S&P 500? Commodities, which we will talk about in the context of futures. Gold, for instance, is a large source of investment, especially in less developed economies, definitely for India. That is not covered in there. And finally, how about investment in human capital? What you are paying a lot of money to Hopkins to get your master's degree and to take this course. That is an investment, and that is not captured when you take the S&P 500 as an index for the market portfolio. All right. So all of those things are important depending on what you're trying to do with it, and that's what we should keep in mind when we actually work with the real data and figure out what we need to do with all of this. All right, so what is the CAPM? Let's set it up. So let's say we have this security J, And the RJ is the return on the security J. RM is the return on the market portfolio. RF is the return on the risk-free asset. Then the capital asset pricing model is simply as follows. The risk premium is a constant for security J is a constant proportion of the risk premium for the market. Okay, that's it. It's just saying the expected, the first equation, the expectation of the excess return for security J is equal to beta, which is a constant for that particular, for the market for security J, is a constant multiple of the expected excess return for the market. Okay, that's what this is, as simple as that, which is why the CAPM, you can see why it has been so incredibly useful. So RP, the risk premium, is for security J, as we have discussed before, that's just the expected excess return. And RPM is the risk premium for the market, which is the expected excess return for the market. Okay, market we have discussed before, we are going to use proxies but that's a measurement issue. That's an empirical issue. In order to set up the model, this is the theoretical model is just that. Okay, so having said that, this is not a math course. This is a course in finance, which is all about the real world. So we are going to then say, okay, how do we actually implement it? What do we do with this? Okay, it's great, elegant, simple theory. So now what? So now the CAPM has been around for really decades. It started out in the 1950s, even before I was born. According to my daughter, that's when dinosaurs ruled the earth. In practice, what we have is we estimate the CAPM typically with monthly data, and it really is for historical reasons. You know, back in the 1950s, 1960s, when the CAPM was really our only model available to us, doing those calculations with monthly data was very, very demanding. And so that's what we did. And now, in order for our CAPM calculations, these beta estimates to be consistent with historical estimates, we will typically also do it with monthly data. So how is the equation? When we're doing with monthly data, we will estimate RJT minus RFT, which is the excess return on month T. This is we're doing with monthly data of security J, RJT minus the RFT, which is the risk-free return monthly on that particular month, equals beta. This is the constant we are going to estimate, equals the first variable here is RMT, which is the monthly return on the market minus the risk-free rate, plus this epsilon J, which, you know, bad old days in statistics, we would call it the error term. It's not something we, in advanced econometrics, we never say error term anymore. It's the residual. It's the part of the model that it's part of the data that is not explained by the model. All right, and we will see in a short while, this is what we refer to as the idiosyncratic risk, which we will do in just a second. So we have here that risk premium equals beta times the risk premium for the market. Should there be an intercept term? Why should we have it just purely proportional? Should we have a linear, should there be an intercept term? And that is the CAPM with alpha. We just call it the CAPM with alpha. There's, it's not the same model, but the capital asset pricing model with alpha, RPJ equals alpha plus beta. times the risk premium for the market. Earlier, without alpha, that simply is just setting that alpha equal to 0. But if you otherwise, if you want to keep it in general, alpha is RPJ equals alpha plus beta MJRP risk premium for the market. And if we want to estimate this, the CAPM with an alpha, in practice, once again with monthly data, we have on the left-hand side the return, monthly return for security J for month T minus the monthly return for the risk-free asset. You regress that with an intercept term on the variable here, which is, as before, the excess return for the market for that particular month. What is this alpha? In a sense, it is an excess return. It is a return over and above what is predicted by the CAPM without alpha. When you have the alpha, rather, let me go back to it. When we don't have an alpha, but you have this epsilon, the alpha aspect is included into the epsilon term. It becomes part of the idiosyncratic risk. So in that sense, alpha is part of excess return. Okay. Now, in equilibrium, under all the assumptions that we have listed earlier, in equilibrium, alpha is equal to 0. And in empirics, with actual data, we find that alphas typically are very, very, very close to 0. Okay, which is very comforting that these equilibrium theory results are consistent with what we see with the data. So first thing that we are going to then look at is this discussion of systematic risk. What is that beta that we have here? The risk premium of security J equals beta times the risk premium for the market. All right. So, so therefore, this beta is an indication of how much the risk for security J moves with the market. So if the market were to increase its excess return by 1%, then the risk premium for security J will increase by beta percent. So if beta equals 1, for instance, this is where a firm, the security moves exactly 1-to-1 with the market. Then if there is a 1% increase in the risk premium of the market, then there is an exactly 1% increase in the risk premium for the security that is being studied. Let's say, what if beta is equal to 0? Then that is to say, the risk premium, if the market's risk premium were to increase by 1%, the risk premium for the security J in question doesn't change at all. It's irrelevant in terms of movement on the market. Can the beta be negative? In principle, sure. This is the idea of pro-cyclical versus counter-cyclical. You can have a situation where a market, where a firm actually does better when the market goes badly. So, for instance, there were some nuclear cleanup specialized firms. Their returns would be better off after the Fukushima nuclear disaster. Okay, while the Fukushima nuclear disaster was horrible for the entire economy, but for that particular counter-cyclical firm, you can have, in principle, beta be negative. However, we do observe betas being negative very, very infrequently. All right, so going back to our beta. So this beta MJ is actually the covariance of the return of security J with the market return divided by the variance of the market return. So this market beta is widely used as a measure of riskiness. However, as I mentioned earlier, it is not directly a measure of the riskiness of a security. However, it measures how the security's return varies with the market. How sensitive is the risk premium for a particular security? How sensitive is that to a change in a return of the market? It's that sensitivity that beta uh, contributes to measuring. So, if you ask the question, go back to this bullet point that I'm mouse my mouse is over right now. For an investor holding the market portfolio, yeah, then beta J answers the following question. If I were to increase the holding of security J, what is the marginal effect on my overall risk? Okay, that's what beta J measures. It's not riskiness per se, but it contributes to that asking of how much all of this changes as a result of a certain particular change in a holding. All right. Now, this is the part that we need to keep in mind. Is that this is the risk that you cannot diversify away. Remember, you're, a security, but this is the idea of firms being not large enough to have an impact on the market. That's a firm cannot do anything about its dependence on the market portfolio. The market as a whole does badly, then this particular firm's relevance of its return does matter according to this beta, and there is nothing you can do about it. Okay, so you cannot diversify away. That is systematic. So kind of just to make sure we have it all under control here. Our CAPM equation can be rewritten as Rj minus Rf equals beta times Rm minus Rf plus epsilon, where this covariance of this epsilon with risk with the market return is equal to 0. All right. So then we can just take the variance of this excess return. The variance of the left-hand side equals beta squared times variance of the excess return of the market plus the variance of the epsilon G. Okay, so this part, beta M squared times the variance of the excess return of the market, that is the systematic part, and the variance of the epsilon J, that is the idiosyncratic part. All right. So once again, variance of a particular security, which of course is a square of the standard deviation, the square of the volatility, that can be decomposed into a systematic component and an idiosyncratic component. Okay, the systematic component is equal to beta mj squared. Beta is what we were just spending so much time on discussing, and we will do a lot of time, a lot of work in the next few minutes on getting to beta, understanding beta. And so this, you can see why beta is such an important measure of systematic risk, because this beta mj squared times variance, that's the systematic part of the risk of a particular security that cannot be diversified away, that a firm will have to bear no matter what. And this variance of epsilon J is the idiosyncratic part. That's the part of the risk that is specific to that particular security, that cannot be explained by the model. And this is the one of the implications which we will about later, that CAPM argues that the theoretical implication of the CAPM is that an investor will be compensated only on the systematic risk it incurs. Okay. The other part of it, the variance of the epsilon j, which has zero covariance with the movements of the market. That's a part that is not explainable by the model. That is a part that cannot be diversified away. That is the part that is specific to that particular security. Has a lot of implications, particularly in market efficiency. But you cannot expect an investor to be compensated for any idiosyncratic risk it bears. Its compensation is purely a function, according to the CAPM, of the systematic risk it bears. Let's pause for a short while, and when we come back, we will go into details of the empirical work on the CAPM.